Welcome to the deep dive. Today we're opening a case file, one that really hits every single corporate budget, from the biggest multinational corporation all the way down to a fast-growing startup.
hmm
We are conducting what is basically a high-stakes forensic accounting thriller. We're investigating in the sudden, really dramatic, and frankly surprisingly violent collapse of the easy profit margins that the entire enterprise software world has enjoyed for years.
And this deep dive, it's deeply personal for, I think, every IT leader and CFO out there.
Yeah.
Because we're here to investigate this structural crisis that we're calling the death of the $300 seat.
Right, that number.
For years, that fixed per user fee, so predictable, so scalable, it was the absolute bedrock of the software as a service industry, SaaS. It fueled these astronomical valuations all across Silicon Valley.
Of course.
Our mission today is to really analyze this recent turbulence, the mass layoffs, the slowing growth, and uncover the systemic failures, the hidden costs that are ultimately driving up the total cost of ownership, the TCO, for every single organization using these tools.
And the evidence, it's already overwhelming. We've all seen what analysts are calling the SaaS massacre playing out in real time. We have to start with the market leader, right? The giant. Salesforce.
You have to.
We have to look at them to really understand this initial anomaly, their financial performance. It's showing these major signs of stress. It's shifting from this rapid growth engine to something much more mature and, frankly, tired.
It's a critical inflection point, no question. While Salesforce is still an incredibly large company, its revenue growth rate has slowed way down. We saw this most clearly in their fiscal year 2024 results.
Okay. Year-over-year
Revenue growth clocked in at about 11%. But the projections for FY25, they show that trend continuing downward, dropping to somewhere in the 8% or 9% range.
And that number, 11%, even the 8-9% projection, it sounds fine on the surface. But when you look at the historical context, that tells a much darker story about market maturity, doesn't it?
It absolutely does. This deceleration isn't a flash in the pan. This growth rate has been in a steady decline for 13 consecutive years now.
13 years? What?
That is the clearest signal possible that the market has matured. They've saturated the enterprise segment. For 2 decades, Salesforce was the undisputed disruptor, right? The agile upstart. Now they're the incumbent. And they're the ones being disrupted by this new generation of efficiency-focused rivals. That kind of sustained slowdown, it fundamentally changes the whole investment thesis.
And the consequence of that slowdown has been swift and, brutal. Mass layoffs.
Yeah.
We saw Salesforce cut over 1,000 workers recently, and they made an announcement that, to me, was the most telling thing about their long-term strategy. They plan to remove roughly half of their customer support staff.
Yeah.
Just remove them. And replace those high-cost, high-headcount seats with sophisticated AI tools.
This is a brutal calculation.
It's a brutal calculation about where human labor fits into the future of their cost structure.
It's not just brutal. It's a necessary, forced strategic pivot. For years, the story was growth at any cost. Now it's a forced march toward rigorous profitability. And that's largely being driven by activist investors who are demanding better returns now that the growth engine has slowed.
So they're finally moving away from that classic Silicon Valley mantra of prioritizing market share over profit.
Precisely. They're targeting a goal of exceeding a 10% operating margin in FY24. And you have to think about the scale of that task. That represents a 3-fold increase from the prior fiscal year.
That's 3-fold increase.
Yeah. To achieve that level of operational efficiency jump while your top-line revenue growth is stalling, that requires extremely aggressive cost-cutting measures, especially in highly leveraged areas like sales, marketing, and support.
Okay, let's unpack this. Why is a market leader an absolute cash machine with nearly 80% gross margins? The cost of delivering the software itself is incredibly low. Why are they suddenly focused on mass cost-cutting and efficiency? It shouldn't be this hard for them to be profitable.
Right.
What's the structural issue that's making the customer bill so high while Salesforce still has to resort to these measures?
The answer is that the crisis is two-sided. The customers are suffering because of this systemic rot that has been destroying the value of the software from the inside.
Okay.
And this rot, it's independent of any market downturns. And it's the reason that $300 seat is just, it's unsustainable. We need to expose the true silent killers of value that have inflated the total cost of ownership.
And those are
integration debt and shelfware.
Integration debt. It sounds less like a technical term and more like a toxic leak in the financial plumbing of every enterprise IT department. For the listener, What are we talking about here, specifically in terms of real costs?
We're talking about the sheer crushing labor cost of trying to connect dozens, sometimes hundreds, of these fragmented best-of-breed systems. You've got Salesforce talking to your legacy SAP ERP, which is talking to your specialized HCM platform, which then needs to report back to your financial ledger.
Right, the classic spaghetti diagram of logos.
Exactly. And getting these distinct software applications to share data, synthesize it, and act on it consistently requires bespoke, custom code.
And that custom coding, like stitching together of systems, that's the debt. That's the recurring cost.
That's the debt. And the numbers are just staggering. We found that custom integration labor costs large enterprises, on average, $3.5 million annually.
Say that again?
$3.5 million
Yeah.
annually. And that is not the software license fee. That is the internal human labor expense just to glue together software you already bought.
So $3.5 million in internal labor just to do system janitorial work. That is an unbelievable internal tax that an organization is forced to pay just to keep the lights on and stop systems from actively fighting each other.
It is a direct result of this decades-long trend of buying dozens of specialized clouds and applications that just don't speak the same language. They don't operate on a unified data model.
So where does that number come from? How is it calculated?
That $3.5 million figure is calculated based on IT teams reporting that they spend 35.55% of their total annual IT staff spend, which averages out to about $9.87 million just on designing, building, and testing custom integrations.
A third. Over a third of their entire budget.
They're dedicating over a third of their budget simply to maintaining connectivity.
And the cost, it has to go far beyond just dollars. This creates a massive opportunity cost, right? It's starving the business of the ability to innovate or even execute on basic strategies.
That's the true tragedy here. Think about what this constant fragmentation and integration burden does to the capacity of IT teams. They are spending over two-thirds of their entire available time, a shocking 68% just running the business, patching systems, keeping the lights on.
68% of their time is just maintenance. That leaves only 32% for innovation, for strategic projects, for transformation.
Precisely. And the consequence is clear. We know that only 37% of IT teams managed to complete all the requested projects last year.
Only 37%.
Yet, because of market pressure and digital transformation demands, those same teams are being asked to complete 30% more projects this year.
It's an impossible situation.
It's an impossible situation fueled by integration debt.
So the reliance on these custom connections and integrations is creating an impossible bottleneck for any kind of digital transformation initiative because the people who need to be building the future are stuck debugging the present.
It absolutely is. Data silos remain a challenge for 90% of organizations year after year. And nearly 9 out of 10 organizations cite integration challenges as the single most critical blocker to digital transformation entirely.
So it's the #1 blocker.
It doesn't matter how innovative your new AI software is if it can't access the trapped siloed data in your legacy systems without sinking millions into custom API work.
Okay, so that's the $3.5 million integration debt, a massive hidden tax. The second silent killer you mentioned is shelfware. This sounds like, what, paying for a gym membership you never use, but scaled up to multi-million-dollar corporate contracts?
That's the perfect analogy because it really focuses on waste. Shelfware defines how companies waste astronomical sums on software they already own, but whose licenses just sit on the shelf unused, or they're tied to employees who have left or whose roles have changed.
And the problem is baked right into the model.
It's baked directly into the traditional seat model itself. Fixed proprietary licenses and SaaS subscriptions require you to pay whether the service is used or not.
And when you layer that high fixed price per seat, say $300 a month, with the sheer number of users in an enterprise, even a 10% unused license count becomes this massive unnecessary expense.
It compounds so rapidly. Gartner's been advising chief information officers who are facing these intense cost pressures that they have to audit their entire software portfolio and do it rigorously. The core mistake they identify is freezing costs, which is passive, instead of actively eliminating them. CIOs have to retire duplicate, expired, or unnecessary licenses to achieve any real permanent savings.
This brings us to the full picture of total cost of ownership, the famous TCO iceberg. We all spend our time focusing on the licensing fee, that $300 a month. But that's just the visible tip above the waterline, isn't it? It's the smallest piece of the financial commitment.
That's the great deception. Underneath that seemingly simple licensing fee are these colossal, opaque, hidden costs.
Mhm.
We've already detailed the massive custom integrations, that $3.5 million labor tax.
Right.
But you also have data migration, which often requires specialized consultants. Then there's user training programs, which can cost anywhere from $500 to $1,500 per user, depending on the complexity of the platform.
Wait, let's stop there. $500 to $1,500 per user just for training. Why is that cost so high? Is it just paying for consultants?
It's the time commitment and the complexity of the platforms themselves. When you buy a highly customized system like a large enterprise CRM, the training isn't just a 30-minute webinar.
Oh.
It involves days of dedicated staff time, custom course material development to align the software with your specific business processes, and then there's the lost productivity while employees are actually in that training.
And because these systems are customized and fragmented, you probably need different training for different systems, too.
Of course, the complexity of the architecture directly increases the training TCO.
And all of this is compounded by the necessity of change management every time a major new system is rolled out.
Exactly. Extensive change management. Just getting users to actually adopt the new complex process is a multi-layered financial commitment. When you calculate TCO correctly, you realize the licensing fee is maybe 20% of the true lifetime cost of that system.
So 80% is hidden.
The other 80% is the labor, the customization, the migration, and the training.
So if the architecture is that complex and expensive, and the user training is a major cost center, how do businesses fight back against the specific problem of shelfware and unnecessary licenses? What's the move?
This is where we shift from just identifying the problem to actionable solutions. One immediately actionable step against shelfware is a rigorous focus on identity and access governance, or IGA.
Okay, IGA.
IGA is the formalized process of auditing and managing user identities, their roles, and their permissions within the system.
So it's not just turning off the accounts of people who left last month, right? It's much more systemic than that.
Much more. IGA ensures you have formalized processes to remove inactive users, but more importantly, it enforces least privilege policies, meaning users only get access to the specific modules and functions necessary for their job. This reduces the overall license footprint, and it minimizes security risk.
But I have to ask, if systems are so fragmented and siloed, doesn't implementing IGA just become part of that expensive integration debt you were talking about?
That's the catch.
Yeah.
Yes. In fragmented, customized systems, implementing effective IGA is extremely difficult, and it just adds more maintenance overhead.
Yeah.
If you have 5 different cloud services that don't share a unified identity layer, you have to manage 5 separate IGA policies.
Wow.
This is why when you have highly restrictive licensing based on seat count, making sure every single licensed seat is actually tied to an active, productive user is one of the most direct ways to eliminate waste, even though the process itself is so complex.
Now that we've identified the weapon, the systemic fragmentation and cost bloat, let's zero in on our primary suspect. The incumbent that built its entire empire on this very structure, Salesforce. We need to analyze its structural benefits, but also its critical weaknesses.
And we have to start by respecting the fortress they built.
Right.
Salesforce is, by size, the undisputed dominant leader in CRM software globally. They have spent decades building a vast, powerful ecosystem, including the App Exchange, which gives them a monumental advantage.
And the high switching costs are one of the biggest deterrents for competitors, right?
Yep.
That's the real moat.
Absolutely. For large corporations, their core business processes, how sales flow, how service tickets are managed, how data is stored, it's all deeply ingrained in the Salesforce platform. Extracting and migrating that data and retraining thousands of users represents a massive financial and operational risk. That lock-in is the core structural benefit.
And financially, despite the recent slowdown and the focus on cost-cutting, they are still a powerhouse.
Oh, they are still an absolute cash machine. They maintain a remarkably strong balance sheet with around $13 billion in net cash. And critically, those exceptionally high gross margins we mentioned, nearly 80%. This financial strength is precisely what allowed them to operate for so long with less rigorous cost controls and a much higher sales and marketing budget than their competitors.
But their structural weakness, the Achilles heel that the disruptors are currently exploiting, is the fragmentation that's just inherent in its growth by acquisition model and the resulting cost.
That is where the critiques hit hardest. Salesforce is consistently cited in analyst reports as a very, very expensive solution. The sheer price and complexity is a nightmare for procurement departments. You start with the base licenses, Sales Cloud, Service Cloud, which run around $200 to $250 per user per month.
And that's already high, but it's just the starting point.
It's just the start. If you want modern capabilities, particularly the integrated AI features that are becoming essential for productivity, you have to start piling on the Einstein add-ons. And these are not cheap. They range from $50 to $220 per user per month, depending on the tier and functionality.
So if an enterprise wants a comprehensive, competitive AI suite configuration for its sales team, the annual cost per user can just skyrocket far beyond that base fee.
It quickly becomes prohibitive. For a comprehensive high-tier configuration that includes all the necessary AI and advanced features, the total cost per user can push up to $825 per month.
$825.
Do the quick math. That's nearly $9,900 annually per user. And remember, that is before the mandatory implementation and integration fees we already discussed. You're not paying $300 anymore, you're paying closer to $10,000 a year just for the license and add-ons.
Let's detail that implementation overhead again, because $10,000 a year per user is terrible, but the cost of getting the system to even work initially is the real killer.
It requires monumental effort and specialized consulting. Mid-market deployments often start at $50,000 and can stretch to $200,000. Enterprise projects, especially those touching legacy systems, frequently exceed $500,000.
Wow.
And this is all due to the architectural complexity and the fragmented nature of the systems they've acquired over the years. This follows the deeply ingrained traditional model of configure first, value later.
And that configuration period is long. It's not, an instant plug and play.
No. We are talking anywhere from 6 to 18 months before a company sees a measurable positive return on investment. The money goes out immediately, but the value is delayed by all this technical complexity. This is a massive vulnerability that the new AI-native players are exploiting, the promise of instant value.
And to support decades of this high-cost, high-growth motion, their internal structure developed a serious case of bloat in one critical area: sales and marketing.
This is the operational vulnerability that the activist investors seized upon. Salesforce's sales and marketing expenses were reported at an astonishing 40.4% of revenue.
40%. 40% of every dollar they bring in goes to S&M. What does that even mean in practical terms? How does that compare to the industry standard?
It is wildly inefficient for a company of their scale. If you compare that figure to a mature, highly efficient tech giant like Oracle, whose sales and marketing spend is 18.1% of revenue.
Half. It's less than half.
It's more than double. That 22.3% difference represents hundreds of millions, possibly billions, in potential savings. That gap explains why they're under pressure. They were spending twice as much as their competitors to capture a dollar of revenue.
So their entire business model was predicated on outspending the competition to acquire new customers at any cost. And now that the market is mature, they have to pivot hard.
Absolutely. And this brings us to their current defensive strategy, the Oracle playbook. They are actively trying to cut costs and structure themselves like an older, more efficient tech company that has mastered the art of maximizing profit on slow, predictable growth.
What exactly does taking a page from the Oracle playbook entail beyond just lowering that S&M percentage?
It signifies a deep cultural shift toward operational rigor. For Oracle, their playbook means ruthlessly focusing on operational expenses, not just S&M, but also general and administrative costs, optimizing the supply chain for software delivery. For Salesforce, it means scrutinizing every aspect of internal operations to reduce expenses and increase profitability. It means focusing on efficiency over the pace of growth.
So as growth slows, the operating philosophy has to stabilize and become extremely predictable, regardless of market fluctuations.
That's the goal. Oracle's year-over-year revenue growth has historically remained consistently in the single digits, and their investment and expense strategy doesn't dramatically change based on whether revenue is contracting or expanding.
Right.
Salesforce wants to reach that same stability, ensuring that revenue growth is a metric, but no longer the metric that dominates every corporate decision. This new focus on profit is now stabilizing the approach to running the business as growth inevitably slows down to market rates.
Okay, so now we move to the rival lineup. The competitors know precisely where Salesforce is weakest: fragmentation, complexity, and cost. Let's look at how the established rivals and the newcomers are weaponizing TCO, starting with a company that pioneered that efficiency playbook, Oracle CX itself.
Right. Oracle's customer experience, or CX strategy, is an aggressive, unified front against what they frame as Salesforce's collection of disparate, expensive clouds. Oracle CX claims to offer a far more comprehensive solution at a significantly lower TCO.
And how do they achieve that TCO advantage? Is it just lower headline licensing fees, or is it structural? Are they aiming at that $3.5 million integration debt?
It's largely structural efficiency targeting that debt. Oracle claims to reduce the need for extensive customizations by offering more robust out-of-the-box functionality. Customization, as we know, not only raises initial implementation costs, but it dramatically increases ongoing maintenance costs when upgrades occur. And it adds all these hidden costs related to constant testing and infrastructure management. Furthermore, Oracle offers more out-of-the-box connectors, which contrasts with the often cited need for Salesforce customers to purchase and build connections on a separate, expensive third-party integration platform.
They also seem to stress the difference between Salesforce's front office focus and a true end-to-end enterprise solution.
That's reason number 2 in their competitive playbook, and it's a powerful one. Oracle highlights its unified front and back office capabilities, meaning their CX platform is designed to natively integrate with their enterprise resource planning, their ERP systems, and their human capital management, or HCM systems. Salesforce is fundamentally a front office solution, sales, service, marketing.
So when a salesperson needs to see inventory or check a customer's payment history, the data has to travel across those complex, customized integrations.
Exactly. Which introduces latency, complexity, and that integration debt we talked about. Oracle offers a global single instance for deployments, meaning all data resides in one unified architecture. That simplifies governance, security, and reporting. Salesforce may require or encourage its users to maintain multiple instances to support various applications and regional complexities, which just adds to the management TCO.
So the bottom line claim is a staggering cost reduction. They're essentially challenging Salesforce's entire pricing model.
Yes. Oracle claims that by leveraging this structural unification and reducing the need for expensive consultants, they can offer solutions that reduce the overall Salesforce subscription cost by up to 50% or more.
50%.
Their pitch focuses on delivering cleaner, unified data for internal business intelligence and AI tools without needing supplemental applications for cleansing and data management. It's a direct attack on that hidden TCO iceberg.
But the truly existential threat to the fixed-seat model isn't just coming from established giants like Oracle. It's coming from a completely new pricing structure driven by next-generation technology. We are talking about consumption pricing, and this is what could truly kill the $300 seat entirely.
This is the fundamental shift. Consumption-based licensing or usage-based models, they move away from fixed fees and instead charge customers based on actual consumption measures.
Okay, so instead of paying for a potential seat, you pay for what exactly?
You pay for things like API calls executed, storage used, the volume of customer transactions processed, or the number of specific AI automations run per month.
So costs directly reflect use. And if the system is sitting on the shelf, the company isn't paying for it. That immediately solves the shelfware problem.
It does. It shifts the entire risk of the unused license from the customer back onto the vendor. This model ensures costs align spend directly with demand, making the value proposition instantly clearer to the CFO.
And we are seeing agile upstarts and even established rivals experimenting with this model to disrupt the incumbents who are clinging to their fixed contracts.
Absolutely. HubSpot, a significant CRM challenger, is actively experimenting with consumption. They're offering a base tier of core users for around $70 a month, but then allowing access to as many additional users as desired, with usage fees kicking in for specific feature consumption.
So that actively separates the cost of the tool from the cost of usage. That seems like a powerful way to democratize access across the enterprise without incurring those crippling license fees for every single employee.
It is. But even more aggressively, the AI-native alternatives, the companies born in the last 3 or 4 years with unified modern architectures, they're pushing predictable, all-inclusive pricing that starts incredibly low, sometimes as low as $19 per user per month for a fully functional modern platform.
$19.
And they can afford to do this because their foundational architecture has zero integration debt internally.
This means the value proposition changes entirely. It moves from paying massive upfront fixed costs for potential access to paying guaranteed variable costs tied to guaranteed results.
It creates a massive, quantifiable TCO advantage that incumbents simply cannot touch. This is the difference between incremental savings and existential disruption. We ran a head-to-head TCO verdict comparing the traditional fragmented high-cost model against this new AI-native efficiency.
Okay, let's break down the economics for the listener. If we look at the numbers for a typical 50-person sales team, a manageable mid-sized deployment over a standard 3-year contract cycle, What's the total investment for the traditional enterprise setup, accounting for the entire TCO iceberg?
The total 3-year investment for a 50-person team using the traditional Salesforce enterprise setup, and this includes the licensing fees we discussed, implementation services, training costs, and ongoing support, is calculated at a staggering $1,323,000.
1.3 million.
Over 3 years, that's almost $26,500 per user.
That is an immense investment, and it highlights why companies are fighting back so hard against these renewal fees. Now, contrast that with the AI-native alternative TCO for the exact same scenario.
For the same 50-person team over the same 3-year period, using an AI-native platform that offers autonomous deployment, consumption-based pricing, and requires minimal customization, the TCO drops to a calculated $134,000.
Here's where it gets really interesting. This difference is not incremental. It is an order of magnitude. It is existential. We are looking at a solution that costs nearly 10 times less over 3 years.
10 times less.
What components of that original $1.3 million are being entirely eliminated by the modern architecture?
The primary cost sinks are gone. The $150,000 to $200,000 in implementation service fees, eliminated, because the platform deploys instantaneously and is designed to integrate seamlessly. The massive training overhead, the $75,000 or more in training fees, drastically reduced because the system uses intuitive, AI-driven interfaces. And crucially, the high fixed licensing fees are replaced by a leaner, usage-aligned model. The fundamental drivers of the $1.3 million cost are simply non-existent in the AI-native TCO model.
And that profound difference is what is accelerating the crisis at the incumbents. They have to change their cost structure and deployment model to survive against rivals who can promise instant unified value at a tenth of the price.
They cannot defend a high fixed price when the value they deliver is hampered by fragmentation that requires the customer to pay that $3.5 million integration tax themselves. The clock is ticking on that architecture.
This overwhelming financial pressure and the emergence of these instant, cheap rivals brings us to our final twist in this investigation. Salesforce's desperate defense mechanism, which they call Agentforce. They are tying their entire future to the AI agent revolution, using it as a shield.
They have no choice but to pivot their entire product thesis toward AI agents. The underlying technological shift we're seeing, generative AI, is the final driver of the cost problem because it fundamentally threatens the need for a human seat.
How does generative AI specifically attack the need for a fixed per-user seat?
It attacks efficiency. Generative AI is poised to fundamentally reshape CRM workflows. Analysts expect purpose-built AI tools agents to improve user productivity by anywhere from 10% to 35% by eliminating mundane, high-volume, low-value tasks.
Like what? What are we talking about?
Think summarizing meetings, drafting follow-up emails, scoring leads based on sentiment analysis, or creating automated reports.
So if an AI agent can reliably perform the equivalent of 2 hours of tedious manual work per day, the justification for a full-price human seat doing that work, or even justifying the high cost of that seat, it just disappears. The work shifts from the high-cost human to the low-cost machine.
Exactly. And Salesforce's response has been aggressive and comprehensive. They're declaring Agentforce, which includes Einstein, Copilot, and their broader suite of agent products, the defining product of the enterprise AI era. They are integrating agents across all their clouds: sales, service, marketing, and acquiring key assets like 10x for voice agents and Zoom-In for managing unstructured data to boost their data capabilities.
But despite this aggressive, expensive posture, the rollout has been slow, and the market seems incredibly hesitant. Why is this transition proving so difficult?
The market is suffering from what we call agent overlap. It is just chaotic, crowded, and confusing. If you look at the landscape today, every major enterprise player, Microsoft with its Copilot stack, Google, SAP, ServiceNow, and specialized AI native players like OpenAI and Anthropic are offering agents across multiple functions.
Right. Everyone has a Copilot.
Everyone. The market barriers have been flattened by AI, and most of these tools overlap in several crucial categories, like meeting summarization and content generation.
This sounds like it's creating a massive state of buyer paralysis among large enterprises who are terrified of picking the wrong horse or, even worse, spending another $500,000 on a system that will be obsolete in 6 months.
That's precisely what is happening. The sheer volume and incoherence of the offerings, the lack of clear winners, means many enterprises are simply choosing to pause their decisions. They're waiting until clear market winners emerge, or, critically, until clearer, standardized pricing models solidify. And this hesitation directly contributes to Salesforce's slower than hoped adoption rates and adds financial pressure ahead of their earnings calls to show visible, quantifiable wins, not just demos.
So if the product landscape is confusing, adoption is slow, and the competition is fierce and cheaper, what is Salesforce betting on to survive this existential threat? What is their single, great, unique advantage that they believe will insulate them?
Their advantage is structural. It's almost a phenomenon of physics. It's the gravitational pull of their data. That they are betting everything on the vast amount of deeply structured data years, even decades worth, that is locked within their various clouds. Sales Cloud, Service Cloud, Marketing Cloud. This proprietary data is the lifeblood required to train and run effective, contextually aware AI agents for that specific enterprise. And this data is notoriously difficult, expensive, and time-consuming to move between systems.
So the data itself is the immovable, expensive lock-in mechanism that protects them from disruption, even if the software around it becomes inefficient.
Precisely. One customer provided the perfect, brutally honest summary. It's very simple. If we had the data stored in Salesforce, we use Salesforce.
Wow.
And on top of that, owning Slack gives them both the critical data storage layer and a daily workflow interface to deploy these agents at scale directly where the users live.
This clarifies the Agentforce strategy perfectly, and it's a profound defensive maneuver. It's not just about offering a better AI, it's a strategy to ensure that as work shifts from requiring a paid human seat to automated agents, those agents are forced to run on the Salesforce platform to access the required data.
Yes.
This preserves the core data asset and, critically, justifies the continued high price, even if the seat concept itself eventually fades away.
That's the core insight. They are using their AI investments to protect the data layer, which is their most valuable and least movable asset. It's a land grab to maintain relevance as the nature of enterprise work changes.
Okay, let's step back and synthesize these findings for the listener, bringing our investigation to a close. We started with the crime, the collapse of easy sauce margins, and the subsequent layoffs. We found the weapon, the systemic twin threats of integration debt and shelfware. We identified the suspects, the bloated giant fighting the agile upstarts. So what does this all mean?
The root cause of your skyrocketing SaaS bill, the one hitting your budget every single quarter, is not simple inflation. It is systemic. It's that $3.5 million annual integration tax and the massive total cost of ownership inherent in highly fragmented, customized, and bloated platforms built on the obsolete premise of the fixed-per-seat model. That architecture is just fundamentally unable to compete with the new efficiency.
And the disruption is happening at two layers simultaneously, creating a crisis for the incumbents. First, the price structure is moving violently away from fixed, predictable seats toward variable consumption-based payment. And second, generative AI agents are replacing the mundane manual tasks that previously required a paid human seat, thereby eliminating the need for that seat altogether.
The pressure is enormous. For the incumbents to survive, they must somehow compete with a TCO that is 10 times lower while defending their massive, complex architectural commitments that demand millions in implementation and integration costs. It's a defense that is becoming increasingly untenable.
So what does this all mean for you, for the organization currently footing this exorbitant software bill and looking for immediate ways to save?
It means you need to shift your internal focus immediately, from expensive expansion to maximizing value from existing customers. Organizations need to pivot resources from merely chasing new customer acquisition, which is becoming increasingly costly due to that high S&M spend required by incumbents, to retaining and expanding existing accounts.
Give us the hard numbers on that shift. Why is retention so much more profitable than acquisition right now?
The statistics are clear. Focusing on improving customer retention by just 5% can lead to a company's profits growing by anywhere from 25% to around 95% over time.
Wow.
You already paid the massive acquisition cost and implementation TCO for those existing clients. Now you have to maximize their lifetime value.
And focusing on expansion requires a completely different approach to managing your software investment internally, which is where those unified platforms can help.
It necessitates investing in strong customer success frameworks that are driven by unified data, not guesswork, which is why integrated solutions are winning. You need to prioritize accounts based on real product usage and engagement patterns and establish clear trigger points for expansion conversations. The focus has to be on maximizing the lifetime value of the customer base you already own, rather than constantly pouring resources into the highly expensive acquisition funnel, which is where the incumbents have historically wasted so much money.
The era of paying for a human seat to perform manual data entry, chase tasks, and fight against data silos, It is rapidly dying.
It is. The future of software cost lies in consumption and autonomous execution. This shift away from fixed per seat pricing and proprietary customization is the only path forward to eliminate that painful $3.5 million integration tax and achieve true, scalable operational efficiency.
This leaves us with a final provocative thought, one for you to chew on as you review your next budget. The real battle in the enterprise software market isn't about which company has the best AI agent or even the best data. It's about which company can survive when AI kills the fixed seat fee and replaces it with a variable consumption fee.
Hmm.
If the high cost and structural complexity of implementation and integration is what has traditionally protected the incumbents by setting a high barrier to entry for their competitors, what happens when AI native rivals offer instantaneous deployment with zero implementation fees? That truly is the new battlefield. And it means the old guard is fighting for their lives against a wave of efficiency they simply were not built to withstand.
The cost model they perfected is now the anchor dragging them under.